Hi everyone, it's Paul Tilley again, and today we're taking a look at an exercise from Chapter 3. This is the Rainmaker problem. So, the fact of the matter is, we'll take a look at the problem and then we'll work our way through it. Okay, Rainmaker Environmental Consultants is just finished its second year of operations. The company's unadjusted trial balance at October 31st, 2020 follows. Okay, so you can see here I have their unadjusted trial balance. So you can see cash 26,000 and the various accounts are lined up in terms of first we have assets and we move into liabilities, payables, revenue, owner's equity, and like. So you can see all of the accounts right here. And here are the balances in them. You can see the various balances, debit and credit. So the fact is, what's happening with Rainmaker is that this is the end of the period, and now we have to do adjustments, non-cash adjustments to them. So there's a batch of adjustments that are discussed. So let's take a look at the batch of adjustments. The first one says it was determined that $12,000 of the unearned consulting revenue had yet been earned. So let's go take a look at what the balance is in unearned revenue. Okay, the unearned revenue has $26,000 balance in it, and we found out that $12,000 of it has not been earned. So what we really need to do is to think about it and say, well, 26,000 in it as a posting. 12,000 has not been earned yet. So realistically, the difference between 26,000 and 12,000 is 14,000. Okay? So that is the amount. So really what we need to do, we are looking at this and saying, okay, there's 14,000 worth has been earned, more or less. So what we need really to do is to create a journal entry that records the fact that 14,000 has been earned. So there's really two accounts that we're looking at here. Unearned consulting revenue and consulting revenue. So what we really need to do is to think about it in terms of what's debited and what's credited. Well, revenue is normally credited. So let's just do this kind of backwards and say the credit we know is consulting revenue. And that would be for $14,000. Okay, and that will bring that consulting revenue account up by 14,000. And we know that the unearned consulting revenue, which is just a counter account that basically says that this is money that we have in storage that we have not earned yet. But what we've done is we've earned 14,000 of the 26. So unearned consulting revenue will be debited for 14,000. So this would be the adjusting entry that would be required right here. Okay, I'm going to do all the adjusting entries first, and then I'm going to look at placing them in the spreadsheet, okay? So here's the first one. Now, next, it was discovered that $14,000 of the balance in the consulting revenue account was for services to be performed in November. So we have $14,000 in the consulting revenue account. Let's go down and look in the consulting revenue account. Let's see what the balance is in that account. Consulting revenue, let's just take a look. Wow, there's $232,000 there in consulting revenue. And we really haven't earned it all yet. So it says that this is going to be performed in November. So what we need to do is to bring down the consulting revenue as recorded in that sheet by 14,000. In order to bring it down, we have to debit our revenue because that would effectively bring it down. So we're going to say consulting revenue. And that would be $14,000 debit. And unearned consulting revenue, that would just record the fact that it's unearned. Will be credited for $14,000. Wrong month. Okay. Next, the balance in the prepaid rent account represents 3 months of rent beginning September 1st. So you got to think where we are now. We're at October 30th. So really it's September, October, November rent. So we have to ask ourselves, okay, that's 3 months worth of rent there. We've used 2/3 of it, or 2 months has been consumed. 1 month is still there. So let's go take a look at the balance in prepaid rent. If we look at prepaid rent right here, prepaid rent says there's $27,000 in the. So if we do the math, that's really 3 months, $27,000. So that's $9,000 a month. 2 months of it has been used in order to get to a balance of $9,000. So we need to consider how much rent has been expensed. So the rent expense has really been expensed for September and October. So 2 months, $9,000 a month, September, October, is $18,000. So what we really need to do is record rent expense and deduct that $18,000 rent expense from the prepaid rent account effectively. So what we need to do is we need to debit rent expense, because normally rent expense is a debit. Two months worth, so that's 2 times 9,000 is 18,000. And we have this prepaid rent. And that prepaid rent then will be credited by $18,000 to bring the prepaid rent down to better reflect the truth. So there's $9,000 left. There's 27 is the balance in it. Before we did the adjustment, 18,000 will bring it down. It'll be 9,000 left to reflect November. Okay. Accrued wages at October 31st totaled $6,800. So we really need to reflect the fact that money is owed to people that hasn't been paid out yet. So effectively, this has to be expense. So we need to go a wage expense. Let's debit that. Wage expense is normally debit. And it's $6,800. Okay. And we want to credit accrued wages. $6,800. Next, we're going to take a look at the office furniture was purchased on April 1st, 2019, and has estimated useful life of 2 years. Over 2 years of use, it's expected that it will be worthless. Okay, so the question is, what was the original price? The original price of the office furniture we recorded here was $84,000. It's going to last 24 months. If we took $84,000 divided by 24, that's $3,500 a month. We're dealing with 1 year of depreciation here. So 12 times 3,500 would be 42,000 in depreciation for the year. Okay, so what we really need to do is we need to depreciation expense it. And depreciation expense is going to be 42,000. And accumulated depreciation would be the opposite account, the credit account, and that would be 42,000. Okay, so let's go on to accrued consulting revenue, for the year totaled $4,200. This is revenue that has added up. And we have an account in terms of accrued consulting revenue. This would be, where would it be here? Unearned consulting revenue. So we're going to reduce that. And that will be for 4,200. Okay, so that would be that one. Interest of $85 has accrued on a note receivable. This is money that's owed to us. So this is revenue. This interest would be revenue, and for the month of October. So really, we need to record that. So that was a notes receivable, right? So we're gonna on the notes receivable. So we're going to record the notes receivable, which is an asset going up. And that will be for $85. And this is interest revenue. Again for $85. Okay, so that would be that one. Then, what else? Okay, the balance in the prepaid insurance account represents the remaining balance of a 2-year policy purchased on April 1st. Very similar to the problem above. So this is $200 a month times 12. It's $2,400. So we're going to record insurance expense for $2,400. And we're going to look at prepaid insurance. Finally, we got account of supplies on October 31st, revealed a balance remaining of $620. So the question is, how much was there to start? So let's go look at the balance in supplies, $5,300. And now there's $620 left. So the amount of used must have been the difference between the two. So that's 4,680 used. So we need really to be able to remove that much from the supplies. So we're going to have a supplies expense. And again, where's an expense is debit for 4,680. And we're going to reduce our supplies, which is an asset, by 4,680. Okay. So, okay, that's effectively what we are with those adjustments that need to be made. Now that we've taken all of the transactions and we've journalized them, we need to then put it into the various T accounts. So we need to draw out our T accounts and run the balances on them as we've done in the previous problem in chapter. For example, you take a look at your consulting revenue account. We had a debit of $14,000, a credit of $14,000, and a credit of $4,200. You add and subtract accordingly, and you get the balance in the account. From there, you take your net adjustments, you add them into the adjustments column, the grayed in area there, and you effectively do the math on it. So you take your unadjusted, you add or subtract accordingly the adjustments, and that will give you your adjusted trial balance, which in turn can be used to produce financial statements for the year.